Although this is options trading workshop, I'm going to add a few extra bits in there as well because it's always useful just to learn as much as you can about trading. So hopefully you find all of it informative. Any questions whatsoever after this, feel free to reach out. My email is at the bottom of each of the slides. So, there's so many people out there that provide education. So I like to sort of prove that I've actually got some knowledge. Well, hopefully I have anyway. A little bit about me. So I am a leading educator and mentor. This is my 50th year in the markets. I started on commodities. So I've got experience across all the different asset classes. The majority of it's been as a prop trader. I mean, even back into the 70s, I still had an account even for the company that I was working for then. And a lot of arbitrage and also a lot of different types of market making as well. So as I say, my commodities was really where I sort of cut my teeth. I stayed in them for about 10 years before I moved across to the financial markets. And I was a senior trader by the age of 22. I've been prop trading for the last 37 years, sometimes within companies, like a few mates or something like that. But generally, most of it's just been me using my own capital. And, when I started, and, I can relate to people getting into the markets because I only started with 10 grand and I built up from there. So yeah, as I say, market making, liquidity providing, that was to both the major energy exchanges. So, sort of quite varied with what I've done. I actually spent 4 years in Italy as a market maker for an Italian bank. Again, sort of just pricing things there. That was great fun, actually. And I consulted to the London Stock Exchange as well. And at the bottom, I put my LinkedIn profile. So in there, I list everything that I've traded and when, so that you can see it's all real. Anyway, that's enough about me. Let's get on with what we're here for. So, again, I don't know any of you, so I don't know what you know about options. Now, for me, I've always been a futures trader. And I love futures. Trading's my passion, so I love all of it. But really, when it comes to sort of trading in general, I'm very much more futures based. But I've been trading options since the 70s, and I use them at certain times. And the last couple of years, last 2, 3 years, ever since COVID sort of came onto the scene, there's been some great opportunities to use options. And there's different types of options. So we've got a call option. That's, when you think the market's going to go higher. We've got a put option where we think the market's going to go lower. And then you've got American and European style options. With the American ones, you can exercise them at any time. So you can close that out. With the European ones, they would always, once they've been opened, they will go all the way through to expiry. It just means you may not own it any longer because you might have sold it and passed it on to somebody else. And then we've got a couple of different types of strategies, which are straddles and strangles. And I'm going to sort of explain these as I go through. And the important things, especially if you're a buyer or a seller of an option, is the strike price and the premium. And then we've just got sort of like little phrases that we use, sort of at the money, in the money, and out of the money. The last one we don't like so much. Okay, so options. Now, although most options are basically abandoned at expiry, which means that they are out of the money, that doesn't always mean that the buyers lost money. And there's a few various reasons for that. Is why did they have the options in the first place? Now, they may have lost their premium, but as long as they were sort of right at least once while they've got that option open, they've had an opportunity to make money from it. So the value of the option could increase where they just sell the option out. But what I actually like to do is trade around the underlying. And that's where it becomes interesting. And I can quite often, not every time, but I can quite often make more money from using the underlying than I actually do from the option. The option is just a vehicle for me. It just gives me a position, basically. And then I'm trading around that as much as possible. But, you know, with an option, you've got to be right at least one time in the duration of that option before expiry to get anything out of it. Otherwise, you're going to lose some, if not all, of that premium. Now, I always think of an option premium a bit like an insurance policy. You know, you have your car insurance in case there's an accident. You have your house insurance in case there's a fire or something else. Even these days, tech insurance just in case our laptop or our phone sort of busts or whatever. And this is the way I think of an option, because you know all of those are just in case. You pay that premium to the insurance company every year, but you don't always claim, so that money just disappears. But that helps to finance the other people that do claim. Now, so for me, an option premium is again just that. But it's in case you're wrong. And the fact is, it's like having a guaranteed stop loss. Because if I go in and I buy options and I pay out my premium, I know the maximum I can lose in that trade. Even if I carry them overnight, if I carry them over weekends, I'm still protected. And that's why I really like them. And when the volatility increases in the markets, that's when they become really interesting. Because then I don't actually have to micromanage the risk. I already know my maximum downside. So when we look at the option premium, so that's the cost of the buyer for that seller to sort of give control of that position to the buyer. So the seller needs to obviously earn something from that. Now, for me, there's two main elements to make up that premium. Time, because the longer the time period's for, the longer that there is for that, you know, for you as the buyer, if you're the buyer of the option, to be right. And for the seller, he's got to control that risk for a longer period of time. And then the second element is the volatility. The more volatile the market is, again, the more that the seller's going to charge for that option. So the longer the time, the more expensive it becomes. And also the fact that if it's a very volatile market, he's going to charge you more because he's got more risk. He's taking that risk away from you. Now, the reason that most options actually abandon at expiry is really around because you can set what price you want to start at. So you've got the at the monies, which is nearest to the current market price. You can go in the money. So if you was buying call options, you'd go below the market price. So you're already making some money. Or you can go out of the money where you would pay you'd have your sort of your strike price higher than the current market price. Now, as you go out of the money, the premium reduces. And that's what attracts a lot of traders because they're not spending so much of their capital to take these options on. The problem is that the market has to go so much more in your favor before you're going to benefit from that. But that is why the majority of options expire worthless. They're just abandoned. Or the other thing is that companies, institutions and such like will use them again as a sort of a hedge, as an insurance policy. And we're going to discuss a little bit about all of this and you know, the way I simplify options. And you know, the daily volatility is calculated. You take that annual volatility and then you're dividing it by 16 for the square root of 256. And that's basically the number of trading days there are in a year. So some of the key basics, an option, as I say, is just similar to that insurance policy. It's just in case, and it's just in case our view is wrong. You know, we're not going to get every trade right as much as we'd love to. It's just not the way it works. And you know, if you think that the market's going up this afternoon, is there a point in actually buying an option? No, of course not. It's too short. You can get these sort of same day options and all that, but don't waste your money. You're better off just having a straight position one way or the other with a stop loss in there. But if you've got that longer term view for maybe next week or next month, for me, sometimes even 3, 6 months ahead, that's when the options can come into play. Of course, they're going to be more expensive, but they're going to give me more time to be right with my view. Now, the options are based off of the underlying or the future, if there is a future. If not, it's just purely based off of the underlying. And again, different asset classes come into play there. Now, the buyer's risk is limited to that premium he's paid, just as if you're paying your car insurance, etc. Now, that gives you the right, but not the obligation. So if you buy a call option and you expect the market to go higher, but it drops down, crashes, then you do not have the obligation to be long of that market at that higher price. Of course, if the market is higher than your long position, then you're going to want to take that position on. Now, and that's sort of your maximum obligation. But you as the buyer get the choice. The seller's risk is unlimited. Of course, they manage that because otherwise they wouldn't last very long. So they use the underlyings to protect themselves. And if you thought of a market that was just constantly going up, I would be happy just to sell call options, even though the market's going up, because I would just cover with the underlying. And then I've locked in that premium, and then as long as the market just keeps going in one direction, I don't mind. I've taken that premium out. The buyer's happy because he's long as well. He's long of the option, whereas I'm long of the underlying. So that can be almost a win-win situation. When the markets sort of fluctuate and they get range bound, that's when it can become a little bit tricky for sellers. Because market looks as though it's going to go up and they're effectively going to be short through the options. They have to come in and buy. The market turns around and goes down again. They don't need that hedge anymore, so then they have to take it off. And that can sort of chew up their premium and even a lot more. And you get lots of option market makers, and of course they're running sort of very big books right across a whole spectrum of products and also strikes as well. So the higher the volatility, the higher the premium is going to be. The longer the duration of the option till expiry, the higher the premium is going to be. So call option provides the buyer the option to be long of that particular market. And a put option is the opposite. Even though you're buying the option, you're buying the right to be short of the market, not to be long. So a call option, you expect the market to go higher as a buyer. A put option, you expect the market to go lower as the buyer. Which, it's almost contradictory, isn't it? I'm buying an option, so I'm buying, but I'm actually buying the right to be short. So, again, that just takes a little bit of thinking about maybe. And then we get the American options. They can be sort of closed out at any time up to expiry, whereas the European ones can only be exercised at expiry. But it doesn't mean that you need to keep it until expiry, because you can sell that on to somebody else. So it's a little bit like sort of pass the parcel. Same as a futures trade. You can buy it, sell it, close it out, etc. So the strike price is basically the base price of that option. If it was oil in it and oil was trading $80.15, it's always rounded. So $80 would be the strike price. And then, you pay your premium on top of that. And that premium is a cost to the buyer. And that over time, that works against the buyer, because that premium will over time sort of erode based on the fact that as the days pass, that there's less time for the buyer to be right with that option. And of course, that leads all the way up to expiry. In about the last week, just over the last week of an option, especially if you've got sort of, say you've got a 3-month option, in that last week, the theta, which is sort of like the time decay, just drops down to almost zero. So then it's just a matter of any value in that is going to be based really on whether you're actually right with that position or not. So at the money, we're using the nearest current market price to get our strike price. As I say, if oil was trading $80.15, the strike price would be 80 if you was doing at the money, because that's the nearest. If you was doing in the money on a call option where you're expecting the market to go higher, then you would be taking a strike price below 80. But of course, you're going to pay a lot more for that because you're already effectively in the money. And then you can go out of the money where you're going to take on your option at a higher level. So the strike price is going to be higher. But of course, that means that the market's got to rally even more before you're going to make any money from that option. If you go long at $82 just to save yourself, say, 50 cents premium, then if you paid $1, really, the oil's got to go above $83. Whereas if for 80 you pay a $2 premium, it's only got to get to 82 before you start to be in. And of course, that's what we're looking for. We're looking to take on these positions, control our risk, and obviously turn a profit from them. Now, some people just trade the options in and out. They just buy it, premium goes up, they sell out, take their profit, and move on to the next trade. That's not my style. That's not what I do. I'm just using the option as an underlying position to trade around. And there are different types of strategies that you can do. And so we've talked about being long of the market through an option. We've talked about being short of the market through an option. But these strategies, you can actually be long and short of the market at the same time through an option strategy. So a straddle is where we are using an equal number of calls and puts, and we're going to use the same strike price with the same expiration date. And by doing that, what we're doing is whichever way the market moves, because we're using the nearest strike price for both, one of them effectively is going to start to go in the money shortly. Now, if I'm buying a straddle, I am going to obviously pay higher for that. First of all, I'm actually going to pay 2 premiums, which is important to remember, because I'm buying the call and I'm buying the put. So that is going to be more expensive. So I've got to cover 2 premiums before I make any money, whichever way that market starts to move. A strangle is similar strategy. The only difference is the strike prices. And basically, to save some premium, rather than going in at the market, I'm going to go long above the market and I'm going to go short below the market. That's going to save me premium, but again, the market's got to move a lot more in one direction or the other before I'm going to get any profit from that position. Now, both of these strategies, if you're buying them, require volatility, because that's what you're buying. You're buying volatility. You're buying the expectation that the market is going to have a big move in one direction or the other. You're just not sure which direction it's going to go. And of course, sometimes you can benefit from both sides if the markets give you that opportunity. You go back to when COVID struck. Sort of, again, you can ratio these, but that's sort of going a little bit more advanced. So let's not go there for the moment. But buying call options just in case the S&P carried on going up, but perhaps buying more put options with the expectation that it was going to go down because of COVID. The market at the time was very strong. So you're just, again, giving yourself almost an extra insurance policy, but you're paying a more expensive premium for the privilege of holding those positions like that. Now, I'm not going to dwell on the Greeks because the idea of the way I trade actually is to remove the need to have that understanding of the Greeks. Um, this is why a lot of people avoid options because of the depth of knowledge you could need to know about the Greeks. I would say if you're going to sell options, you definitely need to understand these in depth. And there's some great books out there that will help you to do that. For me, because I buy options, uh, I, you know, I'm protected. I know the most I can lose when I'm going into that trade. So we've got the Vega, and just quite simply, that's how the option's expressing any change in the price of the option itself, and that change is sort of based around every 1% change that we're seeing in that underlying volatility. So how volatile is that market? And all of this helps the seller to gauge how much he wants to charge in the way of a premium. Of course, these days it's much easier because it's all computerized. It's all just in these programs. It's there in front of you. If you go back to the old days in the trading pits and all that, someone say from a bank would go in, well, so and so called, blah blah blah. All these option guys would come out with a big scroll of paper where they had to open it up to find, where the nearest strike price is and look all the various Greeks to work out what they want to quote in the way of a price. And then the theta that measures the rate of decline. That's the time decay. So as I mentioned, as the option gets closer and closer to expiry, the value of that option reduces from the theta perspective because there's less time for that option to work and to make money. The delta, this is sort of used more for the hedging of the options because what we're doing there is we're using that underlying to help us to manage the risk. Now, we as the buyer of the option don't really need to use that. We can, but we don't need to. Whereas the seller has to be much more careful because they've taken the other side of that position. And you buy that call option for the market to go up and it starts to go in your favor, then obviously it's going against the seller. But it's not going to remove the risk, but it helps to sort of manage it because you understand what you need to do in the underlying to protect yourself. And then you've got the gamma, and that's just a percentage basically. You're looking at the delta because you're looking at, if there's a 1 point move, again, looking at how you protect yourself, how you hedge yourself, what is the risk involved in that. Now, you can get a lot deeper into the Greeks, but, this is sort of just to give you a flavor of options. So we're not going to sort of dwell on those. We're going to move on now. I'm going to look at, what and why we would use options. And again, that's sort of got an element to it. So when we look at, okay, wanting to use options is great, but why should I use them and when should I use them? So if we look at sort of the stock markets, equities, that when there's sort of any political, economic issues going on, then options can be used to sort of hedge that risk. It could be that you're long of a portfolio of stocks, or it could just be that, you want to take advantage of the fact that there's, a potential crisis coming along like COVID or whatever, banking crisis, all of these that are coming along. And then, you can take on options positions to reflect that. If you think that the markets are coming down, obviously you're going to buy put options. If you think the market's going to go up, you're going to buy call options. But it does give you that opportunity to hold the position. You don't have to keep stopping yourself out because it goes a bit against you. You know the most you can lose straight away. You've got effectively a guaranteed stop loss, which is that premium. Now bonds, bonds options have been amazing over the last 18 months because, of course, we've seen those interest rates going up and up and up. And that's obviously a reaction to inflation flying up. And of course, inflation is the sort of the more dangerous thing that impacts the bond values, not the yields themselves, because obviously the yield's going to go up with inflation, which pushes the bond prices, so the future prices, lower. And of course, the same with the interest rates and sort of, depending on which way the rates are going, which way you see the rates going and when, gives you these opportunities to sort of assess where those yields are going to change. Sort of a few weeks ago, the 10-year was at 4%, 5%, and sort of looking really strong. And then, of course, they've dropped off since then. So again, if you sort of bought put options there, calls in the futures against the futures, there would have been money to be made because of the yields changing. Short-term interest rates. Here we're sort of second guessing when the Fed's going to change. And of course, we've seen the Fed put all their prices up and up and up to this sort of 5.25%, 5.5%. Now we're expecting them to come down this year. And of course, yeah, but some traders were too early. At the beginning of the year or end of last year, that some traders are expecting the first rate cut to come in March this year. Now, for me, I just don't see that. I traded Sturs for 20 odd years. For me, I see the first rate cut coming in May, June time. And where some are saying, oh, there could be 5, 6 cuts from the Fed this year. Honestly, I still don't see that. Again, just remember, this is only my personal view. But the reason for that is that I see 3 rate cuts in the States. And the reason for that is because they want to get to that 2%, which they're getting closer to for inflation. But what they're going to want to do is see it stay there for a period of time. They're not going to be in a rush to cut rates, in my mind. And the main reason for that, I believe, is, they're frightened of inflation now, especially because they couldn't control it, because most of inflation was caused by the supply side issues. Although, when you look at the amount of stimulus that was put in, especially in the US, they did contribute to inflation for sure. The Fed put in sort of $5-6 trillion, and of course the government put in a bit more as well. So there was a massive influx of cash, liquidity, and everything going into the system, which obviously inflated all those asset prices. But that's just taken us just a little bit off point. And then Forex. So, here sort of, again, if you've got those sort of economic, political, geopolitical issues, which we're seeing in the markets over the last few years as well, 2 wars going at the moment, and a lot of tension in many countries. And of course, whether it's sort of military war or there's even some sort of like economics potential friction as well to complement that. Then when we move on to commodities, energy. So when there's OPEC meetings, or, we've got a volatile dollar, or again, if there's sort of economic situations, political situations, if you look at 2023, OPEC Plus, they cut quotas 3 times to reduce supply because oil was dropping off in value. They did a 4th one just before the end of the year, but that was voluntary. But look what happened to oil. It rallied over Russia, Ukraine, and obviously that was right at the time. But again, it wasn't sustainable. And then obviously the market came back down considerably. I think it touched about 130. And when you look at it now, it's back in the 70s. So again, the different opportunities that arise. Again, it's making those assessments, working out when to use these, how to use these. In agriculture, around sort of the planting and also the harvesting. And of course, if there's any weather issues. If you look at 2023, the hottest year on record, they're saying that 2024 is likely to be even hotter. And when we go into those sort of areas for crop cycles and that, you know, if you get those really extended dry periods, that's going to sort of reduce the quality as well as the quantity. And then on metals, we can use them as well, gold, silver, and all the base metals, etc. Again, you know, depending on what we see going on within the markets. To be honest, this year, well, last year now, I didn't really trade that much gold because when the central banks are very active, I just think sort of gold becomes that little bit more unpredictable to trade. You know, when the central banks aren't really involved, then you get that nice uh, sort of just beautiful effect of where it has those sort of inverse relationships to other markets, such as the stocks. So those correlations come in, but they also sort of go out. So how do I trade options? Of course, I do exactly the same pretty much as everybody else. You know, I'm going to buy options or I'm going to sell options. For me, I much prefer to buy options. And, you know, when I'm doing my courses, I sort of put the emphasis on buying the options because you know the maximum you can lose on your trade. So if the markets are volatile, and, you know, when I'm going to go into an option position, even though it is an option, in my mind, I'm treating it as if it's the underlying stock or the underlying future. So again, we can take oil. Let's be a little bit more realistic and say $72. And then my strike price, let's say I pay $2. So if oil's 72 and I buy a call option at $2, then my break even is then 74. If it was a put option, expecting the market to go lower, my break even would be 70. So I'm either adding the premium on or I'm taking the premium off. I also incorporate technical analysis into it. Because what I'm trying to do is if I'm going to go long or short, again, it depends how long I'm going to hold these options for. What I'm trying to do then is I'm trying to fine tune my entry level and get the right strike price. If I go in too early, my strategy could still give me some profit, but it's not going to give me anywhere near as much profit. So I'm using options, but I'm using options in relationship, adding the technical analysis into it. I've got my macro sentiment of, you know, why I think the market is going to go up or down longer term that I'm bringing into it as well. So it's a whole combination of things that are giving me and helping me to make these decisions. But, you know, the technicals are going to help me with the timing to get in at the right levels. I don't want to get in too early, and hopefully I don't want to get in too late. Now, I always use at the money options because that's going to work best for my strategy. It costs more in the way of premium, but the fact is that by having it at the money, the moment it starts to move in my favor is when I can start to use my strategy. If it's, you know, if I go too far out the money, the chances of it getting up to past my break even point to start to use this strategy is there's not going to be that much, and I'm not going to get as many opportunities. Of course, you don't always get multiple opportunities, but as long as you get at least one or two, then these trades can really work for you. Now, although I'll keep these options on, quite often I will start to sort of unload the ones that are coming near to expiry 5-7 days prior to it. And the reason for that is because, as I mentioned earlier, you know, that time decay that just drops and you lose all that value. So I try and get out a little bit early just to salvage some of the premium. Now, you know, the fact is that hopefully I've made some good money trading around these options, so I don't really mind. But, you know, if you can sort of salvage something from the option, why not take it? Especially if you've got a few of them, because, you know, every $100, $200 can add up. And the other sort of way I can look at it as well is, you know, if I want to place a stop loss on that, is if the market's really going against me, that if I'm sort of down 50% of the premium I paid out, then that I should exit those options as well. Just take the loss and move on. Yeah, you know, taking losses, you know, no one likes taking them, but I just accept them because it's just part and parcel of trading. And you know, all I do is I just, you know, to rationalize it, I just say, well, I'm just removing my risk. And of course, here I'm salvaging some of my capital as well. So I mentioned that I use technical analysis. So what sort of technical analysis do I use to help me? So candlesticks are obviously, it's the most popular of all of the chart types. But I do sometimes use bars as well. I get too sort of sometimes focused on the colors of the candlesticks, which can work against me. Whereas the bar, black and white, it's giving you the same information, but I'm just using them just for the trends, you know. So if I've got a nice up channel like that and it's coming down to test that, then, you know, that's worth me buying some call options because I'm expecting that to continue to go up. Of course, if it drops through there and it drops down, yeah, I'm going to lose my premium, but I'm not going to lose any more than. I use point and figure, which is one of the oldest chart types in existence, one that you may have seen or may not. And I use that just purely for horizontal support resistance levels. And then I use Heikin-Ashi, and I use that. I don't analyze off of it. All I'm doing is I'm just visually looking at that because it demonstrates for me market sentiment very nicely. And then indicators, I'll use pivot points. It's going to give me some intraday levels again if I'm looking to get into some options positions, or just even some futures or outrights. Then I'm still going to use my pivot points. The MACD with the histogram. I like the histogram because it's just reflecting those vertical bars, just reflecting the difference between the two moving averages. And of course, you know, again, for those longer term plays, I like to incorporate Fibonacci as well. You know, again, they're just looking, is it going to be a retracement or is it going to be a reverse? So options. So I'm looking to take out a position. So I'm looking at the options market. The volatility is there. It's having some good moves. I want to carry these positions over a period of time. So I don't want to just take it on the position on for today. I want to carry it over weekends as well. So again, weekends increase risk. So, you know, do I want to do that? So, but of course, then I want to maximize the profits that I can take from taking out these options. I don't want to just hold on to an option and just go, wow, I've got a little bit of profit in that, because I can sometimes get more profit by trading around that options position rather than just selling the option out and taking a pure small profit. But you know, again, to emphasize, you've got to be right at least once while you're holding on to that option position to get anything out of it. So as an example, if I buy a call option, strike price is 8,800, and I'm paying a premium of 50 points. So therefore, the market now needs not just to go above 8,800, but it needs to go add that 50-point premium on as well. So my break even is 8,850. I've got my strike price, I've got my break even level. It's a call option, so anything above that, I'm going to be in the money. And that is when they become interesting. All the time they're below that, you know, I sort of monitor them, but there's not much for me to do. So an option position is generally sort of a longer term view on market direction. You know, you've got to have that expectation that there's going to be volatility and the market's going to move. Otherwise, you're just going to waste your premium. And of course, being able to use the underlying to hedge the options if they move into the money, is where you can start to sort of really reap the benefits. And I've got a sort of an example on the slide coming up. Now, current market price is 88.10, and we're buying a call option, so that is the right to be long. We've used the strike price of 8,800 because not every single price is listed, and I paid 50 points for that. So therefore, it's my 8,800 plus 50. So my break even is 88.50. Anything above that, then I'm start to be in the money, and it provides me with my trading opportunities around that position. So here is the market. So on the left here is where I've taken on that position. You can see where it says strike price, option purchase with the arrow. So that's where I've gone long. And then that white area is sort of no man's land for me. This is sort of early because, okay, I might have a very slight profit when it goes above, but I'm not going to have very much. But once it gets to that break-even point and goes above that into that profit zone, this area here, that's when it's really interesting. And then because effectively I'm long, so I'm long at 88.50. Anything above that is where I can lock in and take profit. So based on this, if you can see this A just here, this is where I've sold my hedge. And then, of course, the market came down a little bit. So, oh, that was a good sale then. But then, of course, the market rallied all the way back up to where sort of B effectively is. So, you know, that sort of top shaded area just below the very top white is lost opportunity because I could have sold at a higher price to lock in more profit. But, you know, but I was happy because I hedged at A. And then, of course, the market then went up, but then the market started to come down. So I'm long a call option, so I'm effectively long at the market. I've sold out a futures contract against it to lock in. So I've got profit in that trade at the moment. B was lost opportunity. It came down, and then it falls all the way down, actually below my strike price. So now the futures contract that I sold, that I'm short of, I can buy that back at C or around C. Maybe I bought it back a little bit earlier, but I've locked in some really good profit there. And of course, I'm still long the option as well. So the option's not working for me when the market's at C because now the option's out of the money. But I've already paid for more than my premium. I've effectively doubled my money already by selling at A and buying back around C. And then the market rallies back up again and it gets back into that profit zone. So there I am selling as the market's moving up to that D. And then, so here you can sort of see, you know, what I'm getting at in the way that I'm trading around these call options. So I'm long the underlying through the call option effectively. And I'm then using the underlying to hedge and trade around that, whether it's the underlying or the future. But, you know, they're all priced off of each other. So there is that connection there, that correlation that holds in all the way through. You know, sometimes they can move slightly out of line, but expiry, they become one and the same. So they're always going to come back to meet each other eventually. It's just a matter of whether, you know, which sort of converge, you know, where that sort of divergence and then the convergence comes from, which market moves. And then, so at D, I've sold again, and then the market comes back down. And then there's another opportunity to buy back the underlying at E. Then the market rallies again to F. If I sold there, when it rallies again to G, if I hadn't taken any profit, then I can't sell again at G. And if I'm long call options, I can't buy the futures first. I have to sell the futures first. Otherwise, I'm not hedging. I'm doubling up. Again, just think about that one. But then we go on to H, I, J, K. But you can see as the market sort of got that nice sort of range to it, it's giving me these opportunities to trade around this option and make 5, 7, 10 times more from trading the underlying around the option. And of course, you know, when you look at it at expiry, the option was actually out of the money. So I lost my premium. But I've made all of that money by trading the underlying instead of just holding on to the option, thinking, oh, it's gone up or it's gone down. Yes, I could have sold the option several times when it was in the money to take a profit, but I would have lost all those other opportunities. Now, I've got the next slide, which actually sort of breaks down and explains them a little bit more. If you want a copy of these slides, my email address is at the bottom there. Just send me an email requesting them. I'll send you a copy of all of these slides so that you've got them. Okay, so you know that is effectively my strategy, and of course, you know, there's still other elements that you can add to that, but also, you know, when you're hedging and getting those timings right. So here I'm sort of talking a little bit about options, but I'm also talking a little bit about just trading outright, just trading the flat price. You know, you think it's going to go up, you go in and buy. If you're trading CFDs, you buy the CFD or you buy the future or you buy the underlying, whatever it is that you're trading, that you get those opportunities. But, you know, as I say, when you trade the options, you've got just like having a guaranteed stop loss because you know the most you use. But, you know, I like using options, but I love trading the underlying more. I love futures. I love all the strategies that you can create and all that. So, you know, I've been in the markets 50 years, so I've created and developed lots of things over those years. I certainly haven't reinvented the wheel, but, you know, I've come up with techniques that work for me. So when it comes to timing your entries in your trading, that is so important. Even with hedging, you know, hedging those options again, that becomes really important to get that as close to those support and resistance levels as possible. So in trading, you know, if you're already trading, you're going to know this. If you're new to trading, then, you know, good luck, but I hope this helps you a little bit. So timing is everything. You know, you can get in too early and the market comes down enough to stop you out before it turns around and goes in your favor. You know, how many times do we see that? Or we miss that early opportunity to get in and then we get in too late and then the market turns around and then we end up being stopped out as well. And of course, a lot of traders suffer from FOMO, that fear of missing out. You know, don't rush into your trades. You know, you work out the levels you want to trade at. Let the market come to you. And you know, that's when you're going to get those high probability trades. If you know, if you tend to sort of jump into the market too early, then you know you've got to weather that storm more of it going against you before it's going to go for you. If it's going to go for you, of course they don't always. Uh, and you know, it's important not to chase the market. You know, I set my levels. If the market comes to them, then great. I'm going to get a good trade. I'm not going to win all of them. Some of them are going to keep going against me, and I get stopped out. But the ones that do work for me, you know, and I like to build positions. It's very difficult to sort of get the perfect level. And what I mean by that is, you know, 85% of your trades are going to go against you before they're going to go for you, if they're going to go for you, because obviously they don't all. So what I tend to do is sort of break my orders down and average into my trades. You know, you can say, oh, it's dollar cost averaging, which to a degree it is, but at least I've identified where the market is going to stop on the way down or on the way up. I'm not just buying for the sake of buying because the market's going against And of course, if you wait for those perfect levels, the market doesn't always get there. So if I've got a support level here, I'm comfortable buying in front of that. I'm not going to wait for that perfect level. Yeah, if I get it, it's great, but you need to be a hedge fund because, you're not going to trade on all the moves. You're going to miss a lot of them because the market's going to come down, reject early and move away. So I'd rather sort of build my position and get something. And then, of course, try and add to that as the market moves, whether it's sort of to build or even if it starts to go in my favor, I will continue to add to that position. So if you sort of trade in smaller lot sizes, it allows you to sort of add. So rather than just going all in at one price, you can build your position up. So you can either create a variety of levels, or if you're sort of there in front of the screen, you can sort of build it over time. Sometimes I'm teaching, training other guys to trade. I can't be in front of my screen all the time. So, I'll have my orders in there, I'll have my stop losses in and my take profits, and I'll just let them run. And then I sort of monitor them when I get time. But by trading in smaller size, what I'm doing is I'm just trying to build that position up and get a better average. As I said earlier, most trades are going to go against me first, but that's against my entry level. So what I'm trying to do is take advantage of that rather than just watch where I could have had a better price and I don't take it, and then the market starts to move. And when I do that, my stop losses can be based either on the average, or I can take each trade as a separate trade and have a variety of different stop losses against them. Now, whenever I'm going to go into a position, I've got something which I call the 3Vs, and that's volume versus volatility. Now, if the volatility is increasing and I'm trading the underlying rather than the options, then what I'm going to do is I'm going to reduce down the size that I trade so I can have a wider stop loss. But what I'm not doing is increasing the potential loss. I'm just sacrificing a little bit of size so I can move my stop loss further away. Now, what you don't want to do, though, is move your stop loss so ridiculously low that you lose your risk reward ratio, because the chance of that market giving you a profit all the way up there somewhere is even more remote. So, you can save yourself from being stopped out, but that still doesn't mean that you're going to get a profit. And then, of course, you've got to carry that risk properly for days to actually achieve anything. Now, so averaging a bad position, just because the market's going against you is not a good thing to do. That dollar cost averaging where, I bought it and the market's going down, I'll just buy some more. That's wishful thinking. All you're doing is hoping that the market will eventually have that one turn that goes far enough to get you out of trouble. Of course, the problem then is when you could have got out of that, sometimes you don't, because then you're looking for a profit in that trade. It's where the greed comes in. So, but every trade is a new trade, and you've got to trade every single one of them with what's in front of you. But I do like to build positions, and I do like to exit the same way, because overall I get nice averages, and that's what I'm looking for. I'm not trying to sell the top, and I'm not trying to buy the bottom, but I want to take as much out of that market as I can. And again, time frame. So sometimes I'm holding trades for a few hours, other times I'm holding them for a few days or a few weeks. So, it depends on, again, what I'm looking for to get out of that, and the way I'm trading as well. Obviously, if it's options, I can hold on to them a lot longer. And of course, if I'm going to buy sort of piecemeal where I'm going to build that position, I have to work out how much of a gap I'm going to have in between those prices. And I do the same thing for when I take my profits as well. So I deal in zones rather than just exact prices. I identify where I think the market's going to be rejected both ways, but that's it. Then the rest of it is down to me sort of building that size. And when you're sort of creating that position, what you really want to do is over time is making sure that you've got that consistency in your sizing. Okay, we sort of may tweak it slightly because of the volatility increasing or decreasing even. But you try and keep the size of your trades uniform as much as possible. And the reason for that is because it's no good being right with sort of like one contract, which is your minimum, say, and then being wrong with your maximum size, because it just throws all your winners to losers, all your risk reward ratios. It's just straight out the window. And again, it just makes it all more challenging. So you want to try and keep the size as consistent as possible. But, again, just be aware of the amount of volatility that there is in the market. And again, when you're looking at volatility, how can you gauge the volatility? Yeah, options traders and traders will look at the VIX, for example. But, there's other ways is, you can start with a daily candle and see the sort of the length of the candle from the wicks and see how big that is. That gives you an idea of how volatile the market's been on a daily basis. You can bring them even into a 4-hour, and then you can see what's been going on, how volatile. And then, of course, that's quite a useful way if you're using trailing stops as well. Look at the lengths of the candles. It gives you an idea of how far away from the market if you're going to use a trailing stop. Again, if you're not sure of what they are, then feel free to reach out to me and I'll help you. So here I've got my entry level, so 49.75, 49.73, 49.71. My average 49.73. I've just made it really simple. So if I was going to have, say, a 6-point stop loss, then my sell stop would be at 49.67 because that's the average. Or I could have 3 different stops. So I could have one at 69, one at 67, one at 65. I play a lot of chess. So for me, sacrificing the 69s to give my 65s a little bit more of a chance, it can work. Of course, sometimes it doesn't. I get stopped out on all of them. But it doesn't matter because my average is still the same as if I just had the 1 in there. All I'm trying to do is give that last third of my position a little bit more time in the market for the market to turn around. But the loss will be the same regardless. If you've got high volatility, you might just want to have an entry level and a final level and do away with the midpoint, because that way you can reduce your volume down as well. And then when I'm doing sort of the profit taking, it's again the same thing. So my entry level, my mid level, my final level, and then when I'm taking my profit, if I want to 2-to-1 risk reward, I wouldn't lose 6-7 points. So here I am taking 15 points. But the point is that, so again, I start at my average is going to be 49.88 for my take profit, but I could sell early at 86, 88, but then I need to get the 90s as well to make sure that I lock in those 15 points. I've just made it very simple, very small, just, everyone exaggerates with all these big numbers, but you don't need to. It's just about understanding the process. And then sometimes I'll trade around that position as well. So, I'll start to take some profits. Imagine I'm long, the market starts to go up, start to feed some out, and then the market starts to come back again. Then as it's coming back, I'm not sort of panicking, thinking, oh my God, I need to get out of the rest unless my views change. I'm thinking that when it's coming back to where I got in, okay, it's just coming back for a retest. I want to buy back what I sold. And then I've sort of re-established my whole position. And then, fine, if it goes and stops me out, I haven't really lost anything because I've already taken some profits on the way up. But if the market does reject, and it starts to go all the way back up again, then I do the same thing again. I'm feeding into that. All I'm trying to do is just sort of take advantage of the moves within the move effectively. And there's an example of trading around that position. I've got my yellow, my sell zone up there. That's where I want to go short of the market. And once I've done that and the market starts to come down, so I sold at A, market comes down, I've taken some profit off at 1, the market rallies up, obviously not enough to get back into my sell zone, then it comes lower, and then sort of I'm just buying and selling. So at B, I've sold again. It comes down to 2, so there I am taking profit, etc., 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 until I'm either sold out and taken all my profit, or it does come down and it actually goes through my long position and I get stopped out. But the chances are I've made some money. Hopefully, if I get 2 or 3 chances, then that's great. You've got to be lucky to get more than one, I would say. So just remember, when it comes to risk reward, that you want to sort of be managing that for sure. And uh, for me, I want 2 to 1 minimum. That means that if I'm prepared to lose, say, $100, I want to be able to make $200 in that trade. If I can't see that realistically, I'm not interested in that trade. There will be times that I will accept 1.8, 1.7 because I can see that it's not really just going to get to there. And rather than just watch the market fall away, I will sell out 25, 50% of that position, hoping that I'm wrong and it keeps going. And then if it doesn't, then I get out the rest of it as well. And it's sensible. If there's money on the table, I'm not saying grab those profits too early, because you don't want to be doing that either. But what you don't want to see is good money on the table and then end up getting none of it and you get stopped out. And when you're placing those stops as well, when again, when you're going to go into a trade, first thing is analyze. First thing is, how much can I lose in this trade? You've got to think of that before how much you can potentially make in it. And so once you've worked that out, then it makes it much easier, because, okay, I'm going to lose this if I'm wrong. And then that helps you with your sizing of your position as well. And then you can work out, okay, now I need to be able for the market to get up to here. Can it do that? Or is there a support level or resistance levels coming in too early to stop that? And then you sort of can work that out whether it's a good thing or not. And of course, when you're setting your stop loss, you can be based on a technical level if it breaks this support line, but again, financially, because you don't want to lose too much in any one trade. Sometimes it's going to be a combination of both. And it's just a matter of, again, just being realistic with some of these trades. Something I do from time to time, generally when I'm trading strategies on oil more than a lot of the other things, and that is when the market starts to sort of go against me, I might be trading sort of calendar spreads, sort of different expiries in the same contract in the opposite directions. That if it goes against me, I know that when it goes so far against me, that the chances are that the fundamentals have changed and it's going to keep going in that direction. So what I do then is not just cut my position, but I reverse it. Now, what I would say there is you can't do that on every trade, because it won't work. It's not a get out of jail free situation. You're going to, there's times when it'll work for you. There's times when the market will just spike through and then reverse and come back down. But when I'm trading calendar spreads, they tend to sort of have a little bit more of a trend to them when they go. So they'll reject, break. And then on that breakout trade, I want to go from being short, taking a small loss, to being long, where potentially there's opportunity in the opposite direction. So as I mentioned, volume versus volatility. I know I'm sort of going on a little bit time-wise, but I hope you're finding this useful. And we just see how much I can get through of this. I do like to add as much content into my presentations as possible. So as I mentioned before, that volume versus volatility. So if that volatility is increasing, just cut your size down, and you can have a wider stop, but you're not increasing the potential loss in the trade. And that you'd be amazed how much that can work for you. So if your profit target was, say, 200, if you've got high volatility, then you can do 1 or 2 contracts, or 0.2 if you trade in CFDs, whatever it is, and then you want to get that 100 points. therefore you've got your 200. If you've got medium volatility, you might want to double that and go 4 for 50 points. Or if you've got low volatility, you might want to go in 0.8 or 8, whatever it happens to be, for 25 points. But, just again, it's just an idea of, changing the volume that you're trading, the lot size, so that you can balance that with the volatility that the market's showing. As I say, if you want a copy of these slides where it goes into a little bit more detail, I'm more than happy to share them with you. And then trading techniques, there's breakouts, there's momentum traders, there's the guys that like to trade the ranges. Some people look at volume, most look at price action. And of course, we're all hopefully looking at that long-term trend to help us to identify where the markets are going overall, because that will give us a bias on the market. Breakouts, you're just looking, you don't want to trade it inside that range. What you're doing is waiting for it to break out. You're hoping it's not a false breakout, and that once it's broken through, that if it's on the upside, that the buyers are going to keep that momentum going. And of course, that momentum is important because, once that market starts to move, you've got the HFTs, got all the algos out there, all these bots that are looking for that increase in momentum in the market, that volatility growing, and also volume. They want to see both of those. That's what triggers a lot of these algos. That's why you can get those exaggerated moves as well, because what happens is, the market starts to move and then the algos trigger each other, and then suddenly that magnifies the whole move. It does get exaggerated. And that's when you suddenly get all these sharp cutbacks. When I'm in a position, I cover over my P&L. I don't want to see my P&L. Now, the reason for that is because, as long as you've got your stop loss in there, as long as you know roughly where you want to take your profit, always be protected. Always have your stop loss in the market. But, I don't want to be tempted to get out early just because I can see my P&L increasing. Oh, that's nice. Oh, that's even nicer. Oh, that's great. Now, I'll take some off it. I'll get out there because I just made some money. I might be looking to make 2-3 times that. And all I've done is just sold myself short and given that opportunity to somebody else. So I cover over my P&L when I'm in positions. I look at my P&L when I'm out of those positions. Just for confirmation. With 50 years experience, I pretty much know to the dollar in my head how much I'm making at any given time. Anyway, but I want to trade my position. I don't want to trade my P&L. Now, if you're fairly new to trading, you've got to develop a trading plan. And for me, there's 2 areas to that trading plan. And that's sort of like your trade setup is one, but also the financials around that as well. So, again, if you're going to use your own capital, work out the maximum you're going to use of that capital, and stick to that. Put it in an Excel sheet, start from the highest point and work downwards. Don't start from 0 and work up, because you'll just keep moving the goalposts. And of course, if you're still learning, then practice and practice and practice. Build that trading plan. That trading plan are just sets of rules, but they're there to keep you safe, to protect some, if not all, of your capital as much as possible. And that's really important. In life, we like to break rules, but with trading, once you set those rules, trust me, you don't want to. They're there to help you and protect you. And you want to get those entries as accurate as possible. And if you're using charts, then make sure those lines are just touching the bottoms of those wicks or the tops of those wicks. Make them as accurate as possible. I will magnify mine out. I'll actually use a magnifying glass sometimes, because you'll be surprised that that fraction out can be the difference between you getting a profit or taking a loss. So you've got to be really accurate with that. And again, trading should be around flexibility. So, I want 2 to 1, but sometimes I'll settle for less because other times I know I'm going to get 3 to 1 or 5 to 1 or even more. Sometimes I'll get out 80% of a position and I'll make as much on that 20% that I got left as what I made on the 80%. Just because in my mind, I've got a free trade. If I got stopped out, I've still made money. If it keeps going and going and going, okay, you can say, oh, well, why did you get out so early of all the others? But I've scaled into taking those anyway. The last ones, I've just left and just let them run like crazy to really sort of improve, the profit that I'm going to make from that trade. For me, I want to maximize my profit in every trade. But what I don't want to do is get so greedy that I lose the opportunity to take anything from the trade. You've got to manage your risk in your trades. What you don't want to do is go all in on one trade and you just wipe out your account. Trading is a marathon, it's not a sprint.